Hi, welcome back to Self-Ahordian. Let's break down what war actually does to gold and silver using real events and real data. Now, let's get into it.
This is not financial advice.
What if I told you gold was fixed at $35 an ounce, about £14 early 1970s exchange rate? But first, congratulations to Brits and Sovs for getting the first comment in my last video. Then after a major war-driven monetary shift, it exploded to $800. That's around £500 in 1980. What if I told you gold crossed $2,000 per ounce? That's roughly £1,500 to £1,650, depending on the exchange rate, within days of a modern invasion. And what if I showed you that central banks quietly bought more gold in 2022 than in almost any year in modern history? This isn't theory, this is documented monetary history. War is expensive, that's measurable. During World War I, the federal debt rose from roughly $1 billion, that's around £200 million at the time, in 1916, to over $25 billion, that's £5 billion by 1919. European nations suspended gold convertibility to finance wartime spending. During World War II, US debt rose 40% of GDP in 1941 to over 100% of GDP by 1945. The United Kingdom's debt exceeded 200% of GDP during and after the war. And how do governments finance war? They finance it through borrowing, currency expansion like printing physical currency, and also monetary policy shifts. That changes things. For example, interest rates, money supply, or central bank asset purchases made in response to economic and geopolitical stress. Historically, when currency supply expands and rapidly relative to output, inflation risk rises. That's monetary history, not opinion. Now here's where it shifts. After World War II, gold was fixed at $35 per ounce under the Bretton Woods system. That equated to roughly £12 to £14 per ounce. By 1960s, the US was funding the Vietnam War. Foreign governments began redeeming dollars for US gold reserves. In 1971, President Richard Nixon ended dollar convertibility into gold, aka the Nixon Shock. After gold was allowed to trade freely, this period included double-digit inflation in both the US and also the UK, oil shocks and Cold War geopolitical tensions. Mind saying that war wasn't the only factor, but war spending contributed to the monetary pressures that preceded the move.
Please like, comment, and subscribe to my YouTube channel. Become a fellow Hordian, and let's take this journey together.
But maybe that was decades ago. Maybe we've learned from our mistakes, and just maybe modern markets react differently. And by the way, please, if I've made any mistakes, then please let me know in the comment section below. When Iraq invaded Kuwait in 1990, oil prices spiked very sharply. Gold rose from roughly $360, that's about £190 to £200, to over $400, that's $210 to $220 per ounce. Once military momentum became clearer and oil stabilized, gold retracted. Short-term geopolitical shock, short-term safe haven demand. After the September 11th attacks in 2001, US markets temporarily closed. Investors moved capital into US treasuries and gold. Gold began a sustained bull market, starting from 2001 to 2011. During that time, gold rose from roughly $270 to over $1,900. That's from around £180 to around £1,200. During that decade, the US entered prolonged military conflicts. Federal debt increased significantly. The 2008 financial crisis triggered measurement easing. The UK also expanded monetary policy following the crisis. And once again, war was not the only factor. But uncertainty, debt expansion, and monetary stimulus were present, and gold responded. When Russia invaded Ukraine in February 2022, gold quickly moved above $2,000. That's around £1,600. Energy prices surged globally. Inflation in the US and the UK hit multiple decade highs. In the UK, inflation exceeded 11% in 2022, the highest in over 40 years. According to the World Gold Council data, 2022 recorded one of the largest annual central bank gold pushes in modern history. Multiple countries increased gold reserves. Gold has no counterparty risk. It cannot be digitally frozen. It's not issued by another nation's central bank. That's structural, not emotional. How about silver? Silver behaves differently because it has two roles. One is a monetary metal, And 2. Industrial input during wartime. Military production increases demand for electronics and components, but broader economic slowdowns can reduce consumer demand. In the 1970s inflationary period, silver rose from $1.50, roughly 60 to 70 pence, to nearly $50. That's around 30 to 35 pounds an ounce by 1980. Silver historically shows larger percentage swings than gold, with higher volatility and sharper corrections. So does war automatically mean gold and silver goes up? Gold and silver responds to monetary stress and industrial demand shifts. This isn't fear-based commentary by myself, it's an observable pattern. When uncertainty rises, capital moves. When debt expands, confidence shifts. And for thousands of years, whether priced in dollars or pounds, metal gets attention. History doesn't predict, but it leaves a trail. How do you think my ammo box is doing in there? And thanks for watching. See you in the next one. Bye!